Hi, this is a presentation to the Student Investment Society on Valuation by John McCallick. This is the third part of a presentation on valuation. This part is on valuation using dividends and cash flows. All of the models that I'm going to describe have the same basic structure. The models operate over time. So we have to forecast things for a number of years into the future. We need to work out what kind of payoffs we're going to forecast. In our case, that can be either cash flows or dividends. And at the very end, I'll talk about how you might be able to incorporate things like earnings. So that's one thing, what kind of payoffs we're going to forecast. The next thing is, how do we forecast them? And then once that's done, we need to discount each one of the payoffs by a discount rate, and we're going to need to worry about what that discount rate is. Another issue is what to do at the end of these forecasts. We can only forecast for so long, and we're going to have to work out something at the end called a terminal value, or TV for short. So that could be from year 3 onwards or from year 4 onwards. We have to make some assumptions about what will happen in the future and just assume that things will grow at an even rate in the future. And when we get all of that done, all of those payoffs discounted, and we get our terminal value worked out, then we can estimate value by adding everything up. So the basic structure of valuations models is the same for all valuation models, and we're going to start with the discount rate. So that's the first thing we're going to worry about, and then we'll move on to other parts of this diagram and try and work out what we need to do for other parts of the diagram. Now, the major way of working out discount rates comes from finance theory and the capital asset pricing model, or CAPM. And that divides risk, the risk of holding a security, into two parts: the idiosyncratic or non-systematic risk. So this is risk that attaches to individual securities. So this is the risk that Ryanair will do well or badly because of factors that are individual to Ryanair. The other type of risk is market or systematic risk. That cannot be diversified away by holding a larger portfolio. This is the risk that the whole market will go up or down, or will do well or badly. And this, you just can't diversify away these risks. And the CAPM tells us that investors are only rewarded for bearing market risk, so the undiversifiable risk, because it can't be diversified away. You can diversify away idiosyncratic or non-systematic risk by holding a portfolio of maybe 20 or 30 securities. You cannot diversify away market risk, and that's going to be what you are rewarded for. So in order then to work out what risk investors are going to be rewarded for in an individual security, we need to work out how much systematic risk they have and how much market risk they have. And this is what we're going to talk about here. This is the distribution of stock returns for Ryanair. You can get this on Bloomberg using the HRH command, and you can see that the distribution of returns, let me see, what are they? They're daily returns, I'd say, are they? From the 29th of 2nd, 2016 to the 28th of 2nd, 2017, and they're daily returns. So you can see they're centered around 0, and there are some outliers. There's some big positive returns of 5.25% return on one particular day, and there's some big negative outliers as well, minus 5.75% on one day. If we look at sigma up here, that is a measure of the volatility of these returns, and that's 2.133%. If we now go and look at the same graph, but this time for the whole index, the Bloomberg European 500 index, you can see you get the same kind of graph, but there are less extremes, and it is more concentrated in the center here. And sigma is reduced to about 1% from 2 point something percent. So this is the effect of diversification. There's 500 stocks in this index. So, you know, the days where Ryanair has a -5% return, then somebody else does quite well, and your overall returns are not as much as extreme as they are for holding one stock. So what we need to measure is, for Ryanair, how associated are their returns with the returns of the index. When the whole index goes up or down, what does Ryanair do on average? And what does that tell us about the market risk of Ryanair? So this is how we do that. This is the beta screen on Bloomberg, and as you can see, there's a regression where you are trying to predict the movement in Ryanair's stock from the movement in the index. So when the index goes up 1%, so this is down here 1%, what does Ryanair do? When the index goes up 1%, Ryanair does nothing at all. On other days it goes up 1% as well. And we plot that for every day that we have returns for Ryanair. That's for 2 years, I think, of weekly data, and we see what happens over the 2 years. You can see there's some kind of relationship here, and the way the capital asset pricing model is estimated in practice is to draw on a regression line, this red line here, between the Ryanair's returns and the index returns, and the coefficient on that regression, there's only one independent variable there, and it's the coefficient on that independent variable is 0.571, which means that on average, when the index goes up 1%, Ryanair goes up by 0.57%. So in fact, what we're seeing here is that the Ryanair's beta is below 1. On average, Ryanair moves less than the index does. And this is an estimate of Ryanair's market risk. In other words, when everything else is doing well, Ryanair goes up by less than everything else, and when everything else is doing badly, Ryanair goes down by less than everything else. When you're using this beta screen, just make sure that you're using an index up here that makes sense. Bloomberg will choose the Isaac index for Ryanair, and that is not really appropriate because Ryanair is a large part of the Irish market, and you're just regressing Ryanair's returns on itself. So that's what that note is about here. Okay, and that's just what I discussed. For every 1% increase in the market, the Ryanair share price increases by 0.571% on average. Finance theory gives us a formula then. Once we've worked out beta, it gives us a formula for the return on equity, or the cost of equity capital. RE, the cost of equity capital, is equal to RF, the risk-free rate, plus RM, the return on the market, minus RF. Okay, so that's the CAPM formula. So we just need to slot things in there, or in fact, Bloomberg will do it for us. I'll show you the screens in a minute. And the weighted average cost of capital measures the cost of the capital to the business. So we can work out the cost of equity capital from the CAPM, We can work out the cost of debt by just looking at the company's debt and look at the interest they're paying on it. And we can average the two to get the weighted average cost of capital. These are the Bloomberg screens that you do to do that. This is the EQRP, expected return on equity, and that takes the risk-free rate, the expected market return. This one is actually based on the Isaac index, so that's probably not the best, and you can change that. Then there's the beta. The beta is again from the Isaac index, not the Bloomberg European stocks, so you might want to change that. I just left this screen at default. And the weighted average cost of capital then is, as it says, the weighted. So you get percentage of entity equity in the capital structure by the cost of equity plus the percentage of debt by the cost of debt. So you're averaging using a weighted average, which means you use the percentage of equity and the percentage of debt. And Bloomberg do this here on this screen, the WACC screen. And this is the main part you need to look at. Equity has 82.7% of a weight, debt has 17.3%. You get those weights simply by looking at the amount of equity in the balance sheet divided by the total financing, and the same for debt. The cost of equity is 11.4% according to the CAPM estimates, and then the weight by the cost is 9.4%. The debt is only a cost of 1% there, and the overall weighted average cost of capital is 9.6%. Okay, so we'll be using the two of these measures, both the cost of equity, which is up here, 11.4%. Again, this is on the basis of the Isaac index, so I would change that. We'll be using the cost of equity anytime we are forecasting payoffs to the equity holders. We'll be using the weighted average cost of capital anytime we are forecasting payoffs to the firm as a whole. So back to our model. We've now had a look at the discount rate, and we have two measures. We have the COE, the cost of equity, and we have the WACC. Okay. So we have those two discount rates. What are we going to do next? Well, the next thing we want to do is work out how discounting works very briefly. And discounting, as you probably know, operates by taking cash flows or payoffs that you receive in the future and discounting them back to the present. And I think what you should do here is there's a great Khan Academy video where Sal Khan explains how discounting works. And if you've any doubts about how all of this works, then you should go and watch his video. Okay, so we now have discounting rates and we now know how to discount things. So the next thing we're going to look at is what payoffs we can use, in this model. And the first payoff we're going to look at are dividends. And dividends are an interesting one to look at because according to finance theory, that is your payoff from holding an equity security, is the dividends that you expect to receive in the future. So it's completely in agreement with finance theory. Unfortunately, it's not the greatest of models for most firms because it's very difficult to forecast dividends, as they're a financial variable that depends on the directors of the company and what they decide the dividend should be each year. They're not necessarily linked to how much value the company is creating, how fast it's growing, or any of those things. If we do use the dividend model, we also have the problem of can the current dividend payout be maintained? So even if we have a company that does pay a very steady dividend and it's growing at a certain rate, we have to ask ourselves, can it be maintained? What is the general dividend discount model? Well, it's a very simple model. The value of the stock is the dividend per share divided by R minus G. R is the expected rate of return on equity. Okay, so this is the cost of equity we saw in the last section. And G is the growth rate in dividends forever. So if we're able to estimate what we think the dividends will grow at forever, we have the cost of capital, cost of equity capital, and we have the dividends. Then it only takes us a second to work out the dividend model. Again, if you want more details on this, chapter 13 of Damodaran is a good place to start. I'm going to use Intel as the example here rather than Ryanair, because Ryanair are not a regular dividend payer. They do pay out to shareholders, but not in a regular way. So let's look at dividends for Intel. You can see these are quarterly dividends. The last one was paid on the 3rd of January 2017, and it was 26 cents. The one before that was the 12th, the 1st of the 12th, the 1st of December, 26 cents. The 1st of September, the 1st of June. So as you can see, there's a real pattern here. Intel's dividends from 2015 were 24 cents a quarter, then they went up to 26 cents a quarter. Bloomberg are forecasting them to stay at 26 cents a quarter for next quarter. Dividends over the last 4 quarters were $1.04 by adding up the 4 quarters of 26 cents each. So if Intel currently pays a dividend of 104, it has an expected return on equity of 12.7%. I got that from the WACC screen for Intel. Supposing we expect dividends to grow by 3% a year forever, and dividends have grown by approximately 3% for Intel for a good while, so presumably we expect them to keep going. So what is it? It's the dividends per share, 10712. That is the expected dividends per share for next year. It's the 104 multiplied by 3%. Divided by the cost of equity capital minus the expected growth rate, and that gives us a dividend valuation model per share of $13.91. The problem is Intel's stock price is $36.51, so clearly the dividend valuation model is not capturing all of the value that the stock exchange sees in Intel. This is a dividend discount model for Intel. Our current dividends per share, as we saw on the last slide, are €1.04. Our cost of capital is 10.7%. I got that from Bloomberg. That would be the cost of equity capital. And the estimated growth rate of dividends we've estimated as 3%. That is a long-term, if we look at the long-term time series of dividend growth for Intel, they tend to grow at 3% a year. So we can discount the dividends through or forecast them through year 1, 2, 3, 4, and then discount them at our cost of capital, and that gives us discounted dividends for years 1 through 4. The question is then, what do we do by year 5? Well, here we could have just discounted the whole thing along as I did at the last slide, but I'm going to do a terminal value calculation here. The dividends in year 5 are 1.206 divided by the cost of equity capital minus the growth rate, which is 7.7%. That gives us 1566. We then need to discount them back to year 1 using the 4-year discount rate, which is 1.5. And that gives us the same answer as we got with the simpler formula, just discounting them in perpetuity there. But this shows you how you can use a 2-stage discount model. We only need to vary this growth rate here, and then you have a 2-stage discount model, and you can split it wherever you want. So that's an example of a dividend discount model for Intel. I mean, as we saw before, Intel's price is $36, so $13.91 obviously doesn't capture all the value that's in Intel shares. We can also use a two-stage dividend discount model. This allows you to vary the growth rate. You can assume that the dividends grow for a certain period of time at a certain rate, and then they grow at a different rate for a second period of time. And there are all sorts of variations on that model. That particular formula is from Damaduran, if you want to look up his derivation of that. Bloomberg offers a dividend discount model, and it has a number of stages. I think it's a 3-stage dividend discount model. I don't use this screen much. You can have a look at it if you want to. I generally do my own dividend discount models. Okay, so valuation models. The next thing we need to do, we have now covered the discount rate, and we've looked at one payoff, which is dividends. The next thing we want to do is try a different payoff, like cash flows. And this is the discounted cash flow model. You discount future free cash flow as at the firm's cost of capital. And free cash flow is equal to cash flow from operations minus investment. Investment and cash flow are not necessarily matched. So you can have fast-growing firms where they're investing a lot more than they're getting in current cash flow. So sometimes you can have negative cash flow. So this model is not going to be good if you have negative free cash flow, or even small positive free cash flow, where the company is essentially investing all of the cash flow it's getting into its projects. This is how to identify the cash flow. This is a cash flow statement for Ryanair. These are the cash flow from operations, 1.8 billion. And down here, the 1217.7 is the capital expenditure. In Ryanair's case, that is mainly on buying new aircraft. On Bloomberg, you can get more stuff on cash flows, or get a time series of cash flows into the past by looking at FA Financial Analysis CF, or else go into FA and select the CF tab. Okay, so further up the screen, there's all the details about cash flow, but Bloomberg then work out free cash flow over here and free cash flow to the firm over there, 692.8. And the formulas that Bloomberg use are quite easy. Free cash flow is equal to operating cash flow minus capital expenditure. Exactly the definition I had on the slide. And then the free cash flow to the firm makes one more adjustment. It adds back the interest and makes an adjustment for the tax. So essentially you now have a cash flow measure that is to all the finance holders in the firm, not just to the equity holders. So we can maybe work out a value for the whole firm. We have to look at the income statement to get the other items. The interest expense is 71.1 million, and the effective tax rate is 9.45%, which you get by dividing 162.8 into 1721. You can look up effective tax rate on Bloomberg. And that works out then at 692.8, and that measure is free cash flow to the firm. So we now have a new payoff, which is free cash flow to the firm. And we're going to forecast that across, and we're going to worry about what. This is a free cash flow to the firm valuation of Ryanair. What are our model inputs? Well, the free cash flow we've estimated, well, we've seen in the financial statements of 692.8, or we can get that from Bloomberg. The cost of capital is 9.6%. The estimated growth of free cash flow to the firm is 4%. And in this simple example here, I'm going to assume it grows forever at 4%. You could vary that, or you could have a two-stage growth model where it grows by a certain amount for the first 4 years, and then year 5 onwards it grows at another amount. This is what JP Morgan were talking about when they showed us their assumptions for their growth model back in part 1, and they said that they assumed that cash flows would, the long-term growth in cash flows would be 2%. So we start off with 692.8, our current cash flows. We grow them at 4% to 720, up to 842.9 in year 5. We use the discount rate, the weighted average cost of capital discount rate, to discount those cash flows back to the present, and then we add up the discounted cash flows to give this figure here. Our next problem is what happens in year 5 onwards. So we have to do a terminal value calculation. We take the cash flows in year 5, divide by the weighted average cost of capital minus the growth rate, R minus G, to give us the value of the perpetuity, which is the cash flows from year 5 to infinity, which is 15 billion. However, we need to discount that 15 billion back to year 1, or the current year, so we can add it all up. And to discount it back, we use this discount rate here, the 4-year discount rate, which gives us 10 billion. We then add the 10 billion to the 2.4 billion to get 12.8 billion, the value of the stream of free cash flows. That is the value of the firm at this stage, okay? It's the value of the firm, it's not the value of the equity, and what we want is the value of the equity. In most firms, what you do is you take away their debt, because the market value of the firm is equal to the market value of the debt plus the market value of the equity. In this case, Ryanair actually have a negative net debt. They actually have net cash. So we have to add on that net cash of 298.6 billion, which gives us 13.1 billion, divide by the number of shares, and that gives us 9.48 as our estimate of value. That doesn't compare very well with the 14 euro share price. And also JP Morgan got 17 euro as an estimate from a model like this. So I mean, the implication of that is that they must have been using much higher growth rates than we are in their calculations. Down here at the bottom is the calculation of net debt. If you have a look at the balance sheet, you'll be able to find those numbers on the balance sheet. Now that model doesn't work very well for a lot of companies. You can see here General Electric, this is their free cash flow, which was negative in all of these years. So you can't really use this model if the free cash flow is negative. And this is Starbucks. Both of those companies were growing a lot during those times and using up a lot of cash in capital expenditure. Okay, so that's discounted cash flow, and that is the model that JP Morgan used. And there's one more thing I want to briefly talk about, which is using earnings as a payoff in one of these models. So earnings can be used as a payoff. There's a lot of theory behind that, which I'm not going to go into. but I'll just very quickly show you that you can use a very similar type of spreadsheet, but instead of using cash flows, you can use earnings. Now, there's a few things here. Firstly, you'll need to discount at the cost of equity capital, which is 11.4% according to Bloomberg. You're going to have to make assumptions about the growth of earnings, and you'll also have to make assumptions about the dividend payout rate. The way this model works is we work out something called residual earnings down here. See the 75 cents down here, and we discount them in the future, and also discount use a terminal value, and the value you get out of this model is about 914. So this model has advantages because earnings are probably a lot easier to forecast than cash flows, but it also has disadvantages. I'm not going to, analysts don't tend to use this as much as they do discounted cash flow, and I'm not going to get into the technical details of this model. So just to finish off with some quotes from Benjamin Graham, what we're concerned with is the intrinsic value of the security. So that means, has the value got some kind of intrinsic worth that is not connected with what people are paying for it on the stock exchange? Benjamin Graham, who was Warren Buffett's teacher and guru, says that we must recognize, however, that intrinsic value is an elusive concept. You know, in general terms, it's understood to be that value is justified by the facts: assets, earnings, dividends, cash flows. But it's a great mistake to imagine that intrinsic value is as defined and as determinable as is market price. Market price, you can look at in Bloomberg any day. Any value you come up with from any of these models, you know, it's a matter of debate whether it's a real value at all. And long-term growth and terminal values, the concept of future profits, and particularly of continued growth into the future, invites the use of formulas that we have just used. But the combination of precise formulas with highly imprecise assumptions, like assuming the cash flows are going to grow by so much for a very long time in the future, can lead to problems. And it can be used to establish, or rather justify, practically any value one wishes. And this, I guess, goes back to our start when we talked about analyst forecasts. You can justify a value of €17, 1975, 1350 for Ryanair using these models, just varying the assumptions. So to sum up, work out the cost of capital using the capital asset pricing model, forecast future payoffs. You can either use dividends, cash flows, or earnings, forecast a long-term growth rate, and discount the payoffs. And that's how you do valuation using dividends or cash flows. Thank you very much for listening.